Hi, Jeffery. Thank you so much for coming to the Investor Talk. How are you?
I'm very good and very excited to be here today. Thank you for having me.
Thank you for coming. Thank you so much for your time. If you like, let's give an introduction about yourself.
For sure. Well, my background is, I guess, pretty vast. 20 years back, I was a software engineer. I worked for one of the larger retailers in Canada. And then from there, I went on and created my first company, which is called Hardboot. And it is a resourcing platform, resourcing business for big pharma, health tech, and fintech space. We have offices in Pakistan, Philippines, Egypt, and Toronto. And then from that, my early days working within the Loblaws environment, which is the retailer, they didn't know what I did back in the early 2000s. So the front end people would send all of their startups, the businesses that would call into the business, they would send them to myself. And I vetted every call. I went through and learned what they were all doing, and all the companies that I found that were very interesting, I would then work with them to put together a better model to pitch in front of the executives. And then I would meet them in front of the executives and help them sell their business into the large conglomerate, which worked out quite well. So I continued to work with startups from that point going forward. And then about 12 years ago, I started to invest in early stage companies myself personally, while building out my other company. And about 6 years back, some of those companies started coming back and saying, hey, we could really use more help raising funds, getting in front of investors. So we decided that that was kind of a turning point for where we could create our own venture firm. We saw that the problem existed not only 20 years ago, but it existed all the way through, that there was inconsistencies and not enough opportunity for early stage companies to get in front of investors, to be able to learn how to improve their business or modeling. So we decided to create OPN. So the Open People Network was created, and we provided programs that would help early stage companies work through fundraising to grow their business at the same time and meet investors along the way. And through that, we ran over 100 live events. And then fast forward to today, we see about 300 companies globally across a lot of categories, but I would say the three main focus categories that we see the most deal flow from are CPG, which are consumer product goods, consumer facing goods, and fintech and deep tech, which happens to be my background. And from there, we run a program called E2E, which is entrepreneur to entrepreneur. And we provide this as a free open-ended service to help early stage companies get in front of all of our partners, which go across the spectrum, but they vary from accelerators, Founders Institute, Techstars, everybody, Y-Space, they jump in to pull deal flow because the companies that pitch are very early. We pull out 2 to 3 of those companies every 2 to 3 months that we feel that we can work with and make an investment in. So then we will put an offer in front of those companies, and then we put them on a regular call or meeting to help them work through their growth and the opportunities and build up their modeling and their business. And then we will make an investment, close the investment, and then we'll work with them over the next 3 to 5 months, get them into a strong position where we feel we can bring them back to the market. We will then get them in front of our market, which is made up of anywhere between, I'd say, at least 50 plus global investors that join the network to look for deal flow. And then from there, we have already in our first 2 funds, we have over 40 plus angel investors that invested in our first 2 funds. And from there, we utilize the investors to help grow those companies. Our goal is to get as many of our companies to Series A as we can when we make the initial investment. And that's pretty much us. And 90% of the time, we like to be first money in. So we tend to work very closely with our founders and help them along their journey.
Thank you, Jeffrey. What about geography? Would you like
to? Our first 2 funds, we focused on the Canadian environment, but we also had a lot of global exposure from different traveling, different speaking engagements, etc., around the globe. And from that, it really opened our markets up And today we see that 300 companies globally, and they vary across all regions of the world, but more deeply focused, I would say the top are UK, Israel, India, Egypt, US, Canada, Portugal, Spain, Nigeria, and South Africa.
And how much you normally invest in terms of tickets?
Well, we typically do first money in. So when we make an investment, we'll do anywhere from 100 to 250 into a company as first money. As I mentioned, we'll close that round and then open up another round in 5 to 6 months and put in another allotment of capital. And that'll be determined again based on the size of raise and what they're looking to do, but we will do a follow-on investment. And that may vary. In our third fund that we're just launched a month ago, our goal is actually to increase the amount that we'd be doing as initial capital into the company. And we're looking at closer to 500,000 as the initial investment.
What about, where do you find concern when it comes to investing in such a early stage startup? I mean, what do you consider the most, the company, the team, the product itself?
Well, there's a few areas that you can look at earlier on. There is a lot of data. It's not that you're coming to OPN with, hey, I've got this idea, will you guys want to invest? It's a lot further along than that. So when we do work with companies, they could be pre-revenue, of course. And when we do the quick analysis initially to get the conversation going, you're looking at the type of team they have, the type of product. Is this something that's scalable? Is there a gap in the market? What are the real opportunities? And if we can see that within that 20-minute phone call, and we can see that the startup is really understanding the market they're going after and heavily focused on solving one problem and have one solution, then we'll move that along into our next stage of analysis, and we'll start to put together our own primary work, which will be deep diving into the company and all aspects of it, including the market and what's going on and where the opportunities really sit. And we'll go through that due diligence. A lot of it comes back again to the size of market, the opportunity, the team. Team is always a huge component. Even if it's earlier on, they may have a smaller team, 2 to 3 people, but there's a big difference when you have 2 to 3 strong people running the business and you have a strong team of advisors. Sometimes advisors get overlooked. But for us, if you have somebody that has 30 years plus experience in the fintech space and they're advising you, to me, that's a way of de-risking your business. And I really think that a lot of early stage companies really need to focus on how can I de-risk my business to get investors interested. And it starts by having one problem and one solution to solve. Not many problems, just one. Figure out what the biggest problem is that you have, go after it. Focus on that one problem, and then start to take in other pieces, which are, what's the best resource I can bring to support my next stage of business? Who's an advisor that can help me work my way through the trenches of this fintech or this deep tech space that wants to put a bit of time into me and can help guide me and make introductions and move me through the system? Those are things that help de-risk the business. And of course, looking at pitch competitions, the government for some other types of funding that you can receive that don't go against your cap table. So there's lots of avenues that you can go and look at, call it free capital, free knowledge. Anywhere you can get assistance and guidance is going to help strengthen your business and your model. And I think those are the things that prove that a founder is really baked into the business. And of course, if they're in there full time, they can start off part-time to get the product going, to make sure that they have capital. But investors are always looking to make sure that they've got skin in the game and they're working hard and they're going to do whatever it takes to make this business survive and grow and scale, just as the investor is going to take all of their time to ensure that they're going to support you along all the different ebbs and flows inside of your business.
Sorry. How important is face-to-face for you when it comes to when they come in to pitch to you and after having next meeting? Are you going to meet them face to face? It was very common before the pandemic, or now Zoom is or any other video call is pretty okay for you?
Well, I guess we're a bit of an interesting business in that sense is that when I started my first business 15 years ago, we were virtual. So we ran our companies virtual. We didn't do face-to-face. All our meetings were done through Skype. We had offices in Pakistan, Philippines, and Toronto. We met with our clients that way. And the reason is that we try to optimize the opportunity in order to get things done and moving forward and quickly. And we kind of carried that all the way through over the better part of that last 15 years. So when we created OPN and the Supporters Fund, we kind of set it up the same way. We never really deferred too much from what we already knew, which was how can we run an effective investment opportunity and work with founders. I would say today, because we ran a lot of events, we did get to see a lot of our investment companies face to face. But I would probably say we're probably maybe 60-70% of our investments have at least met once. And we've probably got somewhere between 30 and 40 that we've never met face to face just due to travel or anything else. And that's only going to keep changing. So, you know, you might be worried and say, well, how is that possible that you can invest without meeting someone? And well, a lot of the time it's proof is in the pudding, I guess, as that saying is set up to show, is that when we make an investment in a company, we don't just make the investment. We get on weekly, every 2 weeks, every month calls before we actually make an investment. So we're working with you to have you show us all the different proof points of how your business is growing, where the products are, who you're interacting with. We do interviews of investors, associates, people on your team, clients. We dive in deeply to make sure that we have all the right data points that can show us that you're in the right direction and that we can work with you at the same time before we make that investment, because it is early and we want to de-risk it just as much as you do.
What about after investing? How often do you meet them?
Well, the great thing with us is that we're very hands-on. So even though we do all the pre-work to ensure that we're going in the right direction with our investment, we actually continue that. Our goal is to take as many of our portfolio companies as we can to Series A. And it's not just by throwing capital and hoping that they make it there. Our goal is that with our large network of angel investors that are in our funds, is that we allocate and work with them to bring them into the fold with our portfolio companies. So we have a very strong support from our investors, and they want to be participating as much as they can. So we set up with our meetings, we set up again on that every 2 weeks, every month, and every quarter, every company has a regroup with us. So depending again on the stage of where the company is at, we continuously have touch points throughout the journey of every portfolio company and even non-portfolio companies that we're looking to invest in. Again, we want to make sure that if we're putting time in it, that we can understand your model and believe that you are building something great. And that takes effort and time on both parties. And when we support all of our companies, we're bringing investors in for deep dives, we're bringing outside consultants in for conversations. We're doing whatever it takes to kind of help support the company along that journey, because our goal again is we want to have as many successes as we can, and it takes a lot of hands make a lot of less work. So if you don't bring in the right knowledge, you have a potential of losing more companies quicker.
I mean, what's your opinion is the best way for you to add value after investing in a company?
Well, again, it depends on who you're speaking with. A lot of times angels and investors don't have the time to put into the companies. They just use capital as their gateway. Unfortunately, or fortunately for us, we're not just about capital. We're about changing the way the model works. We want to make sure even at an early stage that we do what it takes to help support that company. So that support goes through helping with lead gen, getting them in front of prospective clients, opening doors, solving problems. I can tell you that in the last 5-10 years, how many times I've worked with co-founders that are separating and having to work through legally how that's going to work, to other areas where they've had legal problems that we've had to help massage and work those through the business. So we're always there. We do operate again as board roles, board observer roles, directors. All of those things are part of our mandate to help the companies as they kick off at an early stage. And then when they start to get further along in their growth, we start to look at what other venture partners can we bring into the mix to help them with their next raise. It's really important that not only are we there to be an ear and listen and help them with strategy and help them with introductions and all the things that help build a company up, but there's also stages when they will raise a seed or they'll raise a Series A or a Series B. And we've built venture partners that are interested in the deal flow that we bring to the table. And we want to make sure that we're getting them in front of the right venture partners so they can continue to get that next level of assistance, which comes from bigger venture firms that have been in their ranks for a long time, and they can bring a lot to the game of that company.
You say already you like leading. What about finding the following investors? Are you helping the startups or it's up to them?
Again, this is really dependent on the type of company, where they're coming in at. We typically like to be the first money in or lead the business, but we're getting opportunities coming from venture partners or even the startups direct that have already raised that pre-seed round and they're now at a seed stage. And we really, you fall in love with the opportunity and you see how great the scaling potential can be. You see that there's a land grab going on, or that there's a consolidation going on in the market, and that there's a potential faster exit for a company. You're going to jump in at that opportunity and be able to partner with your venture partners to make that investment. So not every opportunity is going to be first money. You're going to have to evaluate where those companies sit. At the end of the day, your goal is to bring companies to exit or high growth. And in order to do that, you have to look at what is your term. Are you looking for unicorns, or are you looking for 5-year 10x exits? And at the end of the day, we're not looking for unicorns. We're looking for the opportunity to build great companies, build a lot of employment, and have a 5-year exit or a 7-year exit because they've built a great company. And we want to work with founders that can really prove that direction.
In terms of fundraising, as you invest early, when it comes to the next round, are you going to actively help? As I can see, you have also your network of startups, investors. So I think on your side will be for you easier than others to get connected with the next one.
100%. Again, this goes back to our desire to drive our companies to get them to a Series A. And in doing so, we partner with a lot of venture partners around the world. And again, our goal is to bring in the right parties at the right time to help pick that group up and bring them to the next level. And we know what our strengths are, and we know where we have to bring others in that are going to be stronger, better, quicker, faster than us. And knowing that allows us to have that strength, which is have a great bench. And that helps the startup move quicker. So we want to help them raise every round we possibly can. In order for a company to be successful, you have to work with them at all stages and figure out who you can make introductions to that will have an interest in their business and not waste time and be able to jump into them. And that's where we see the potential, is that we build relationships on our side with them and supporting mechanisms that will help grow those companies.
There are some investors who believe, in their model, companies inside the portfolio shouldn't somehow interacting. What's your point of view here? Should your portfolio's company have some kind of interaction?
100%. We work quite often to make introductions to our portfolio companies that we feel will have a good operating relationship, find ways to build value between the two of them, or 3 or 4. We have companies that we haven't made investments into the fund yet that we'll bring into the mix as well, because we see a potential opportunity for a future purchase or a future collaboration. And they may have been just a personal investment. They might have been one that we're really close to making an investment in, and we just decide, this is a great partnership, they should work together. So we're always, again, looking at ways to interact and tie people and businesses together. It's a great way for companies to support themselves. And when you look at our program, which is E2E, it's such an early program of pre-seed companies that even our Series A companies could be looking at and saying, that tech would be a great fit. We should integrate, or we should buy, or whatever that might be. So there's always ways that you have to create more value for your Series Seed or Series A companies. And that's what they're looking for, growth.
Thank you. During the pandemic, we've been talking about pivoting all the time. So it's been 24 months of pivoting. What's your take on pivoting, and what's your advice to founders who do not consider pivoting as failure?
Well, I can say that I've never seen a founder that hasn't been interested in pivoting. We've had one of our portfolio companies, I think, pivot 4 times, and they've raised multiple times on it. And now they found the space that they need to be in. And I think a smart founder, this is also a three-peat founder. So there's a lot of value in the fact that that founder has been there many times and understands the landscape. And when we talked about earlier about having one problem and being focused, when you're focused, you know when the time is to pivot. When you're scattered and you've got too many problems to solve, you'll be all over the map, you'll miss the pivot. So that's why we push and emphasize on being focused, because that will allow you to see the bumps in the road. That will allow you to make the change so that you can chase the value and chase the dollar conversions versus just chasing the build. The build won't get you anywhere. It'll just get you to the next build and the next build. You really have to get out into the market and listen, breathe it, eat, sleep it, and that will help you figure out when to make that next pivot. And that comes to focus.
This is personal. Why did you become an investor?
Well, it's a great question because I thought about this a few times. And when I look back, and the story goes is that when I was working at Loblaws, I created a mind map, and I wrote out this was 20 plus years ago. I wrote out a mind map of the company I wanted to own and what I wanted to do inside of this company. So this is before I went into my own company. And from that, about 6 years ago, I think, or 5 years ago, give or take, I found the mind map. And on the mind map, it actually said that I was going to build this company, Hardboot, and I was going to build a venture firm, and these were everything was going to sit, and I was going to have these outside entities in different countries. And oddly enough, I can't believe it actually came true that way, but so I never probably really understood what venture capital was 25 years ago. But what I did know is that I had a very strong intuition on how to operate and work with inside of a founder's head and with how businesses operate and how you could tie those two together. And being that it was a business and being a developer and a business side, I think what it did is it just gave me a different angle of how I looked at business. And when I started to work in this space 20 years ago, I got so excited about diving into an early stage company that was pitching for business. And I saw so much potential in the opportunity that's what kind of got me into the driver's seat to want to be an investor. Unfortunately, it didn't happen as fast as I could get myself to be able to do it. But as soon as I did, as soon as I had the first capital that I could make the investment, I certainly jumped at the opportunity. So I think it was a long game, and I just learned how to work in between the lines of the market, which was figuring out who could be a potential scale company, who could be a potential opportunity. And then from there, not falling in love with the companies, but understanding the data and figuring out what is the opportunity in this market and driving that forward, which probably is what got me the most excited with this. A lot of data and excitement in these fields. So I think that's kind of how it all got started.
It's indeed a very exciting environment, that's for sure. Which are the critical points that trigger your decision ultimately to invest? Because you see so many startups, so many pitch, but in the end of the day, there is the day when you had to say, okay, I'm going with these guys instead of this one, and maybe both are good. What's going to make the difference?
Well, when you really kind of hone in and focus on that company or the person that's pitching you or all of the pitches that you see, I think what really defines the opportunity is that first engagement that you have with that founder. When they come across and they provide you with that pitch, that she or he, just the way they articulate themselves, the way they have the focus, the way they have one problem, the way they feel like they've been doing this their whole life, you can kind of connect with that right away. And you kind of see inside their eyes and like, oh, this person really is going to drive this as a home run, or they're going to do whatever it takes to get there. So there is a lot of drive that you pull from. Maybe you see yourself in people, all of those normal things that people would go through, But I think it's that initial connection. It's what you get out of that initial connection. Do you feel that this is an opportunity? And then you dive into it. And sometimes, I would say 80-90% of the time, when you hear hundreds and hundreds and thousands of pitches, it's the one that's doing something just a little bit different, that much more unique. And that founder just has that glare of focus and drive, that fifth gear that nobody else has, and you want a part of that.
You just said pitching. What's the perfect recipe, if there is any, to pitch to an investor?
I can probably say this 1,000 times because it makes the biggest difference, but it is a short form pitch that is to the point, not wordy, very direct, very focused, one problem, one solution, show the market, show the value, show the exit, show what the team is behind it, put the numbers together, show how you're making money. And at the end of the day, 1 minute of your pitch should be on the problem and the solution. The rest of it is on how you make money. That's what this all comes down to. Investors want to invest in people that can make money. And you got to figure out how to make money the quickest. So how do you commercialize what you do? So in that whole process, your pitch has to be 90% about how to make money and 10% is on the problem. Because if you can't share what the problem and the solution is in less than a minute, then nobody else is going to be able to follow along.
What's a suggestion to founders when approaching a VC? How they should approach a VC?
Well, in our case, we run a podcast where we interview a lot of angels and VCs around the world. And we do that because I found that a lot of people don't put enough time into learning about the investor, but also the investors don't share enough about themselves. So you don't really have a way to connect with the investor, and you don't have enough information on the web to learn enough about them. So we wanted to try to pull that out so that you could learn more about the investors, so you could find a quick way to connect. So if you find out they like skiing, well, now you've got a point of reference and you can say and talk about skiing. That gets you, gets that warm welcome moving forward a little quicker. So it's just doing things that allow for you to move a little quicker in that space. And then on the other side of it is learning on what they invest in. Find out about the other 10 companies that they've invested in and how similar they are to yours. That means there's less thinking, more interest to want to invest. So you need to find everything out about that investor if it's really, really that important. But meet a lot of people along the way, talk about your business, keep pitching it. But when you're getting in front of an investor, try your best to be really focused and to give them exactly what they're looking for, which is that nugget of difference that's going to get them excited to want to jump into your business. And the more you know about them, the better and faster you're going to be able to get them to dive into your materials and hopefully invest in the future.
What about IP? How important is for you the IP belong to the startup?
I would say that when it comes to the intellectual property or your IP, it's very crucial for any business to be able to have this secret sauce on why they're going to be able to grow their business. If that's from writing patents to just not writing anything, but keeping it under the hood, if it's through code or algorithms, whatever that might be, it's very important for the company to own this IP at some point in time in their early stages. We've worked with companies that had to buy it or they had to source it back from universities. It's really important to make sure that they do this early on, because you can lose a lot of investors, you can lose a lot of interest if you don't own this, because that could be the core of your business and the only asset that your business has that has value. So I think it's very important for founders to not only believe in what they're building, but to ensure that they have the secret sauce, they have patentable material, and they're always working on iterating on that and making it stronger and better, which, as most would call it, building a moat around your business so that you can protect yourself from other companies and competition. But I think IP is very, very important to a business. If they don't have it, then it's a land grab, and you need to work as quick as you can to be either taking the market out by sales growth or buying companies to merge them in, and then start figuring out if you can build IP in that process.
What would be the best and most promising sectors to start a venture in the coming years for founders?
Well, it's an interesting question because I ponder this all the time. Where are we going to see the biggest changes in the future? where are we going to see this shift? And right now, everything is going to Web 3.0, which is decentralizing everything. And I kind of look at decentralizing as what business does every 10 years, where every 10 years they want to cut costs and outsource everything. So they do the outsource model for a few years, and then they realize that their IP needs to be stronger. So they insource it all again. So they start hiring like crazy to bring it in. So I think really at the end of the day, that's kind of what DeFi is doing. It's decentralizing the way you interact with banking, personal information, everything. And I think that's great that you can take it on and start to self-manage. I think big business is okay with that as well. So I think Web 3.0 is going to be kind of the wave of the next 5 to 10 years for sure. I think you're going to get another sector that is just, I think, in its infancy and starting to really pick up is robotics. You're going to see a lot of changes happening in this space. There already are quite a bit of them. You can see from manufacturing jobs in the US in the last 10 years, we've lost over 1 million jobs in manufacturing to robotics. And that's only going to continue to increase in all countries and everywhere. And I think you're going to have to look at, how do I play a part of that game, or how do I be part of that? And it's always taking the lowest role inside of a business and trying to figure out how to automate. So robotics and automation then become very impactful in the industry. So Web 3.0, decentralizing. And I think the third part that I would say that is going to again change this is the blockchain side of it. I do think that it's been punched around as a key word for many years, for over a decade, along with AI. But I think blockchain is going to start to really make a step forward. And the reason being is that you need a way to add governance to how businesses are operating and how markets, stock markets, and everybody are starting to operate. People are demanding this. So I think from a securities level, you're going to start to see a bigger push into the blockchain, into controlling and managing this. And then, of course, AI is always going to be the big elephant in the room, because it's what everybody wants and it's what's generating the value today. So which drives data and a lot of other important tools. So I think those are probably the 4 areas that I think you'll see a lot of push in the next couple of years.
Jeffery, thank you so much for coming to the Investor Talk. It's been a very great pleasure for me. Thank you so much.
Likewise, thank you very much for giving me the opportunity to share, and look forward to chatting again in the future.
Absolutely.